Yes, guys, welcome back after the break. So we'll be starting now with the new topic called capital structure. So it is an extension of the previous topic. So how is it an extension? Sir, in the previous topic, what we learned is how to raise the finance from what and all source, and each source has a cost. And that particular cost only is what we computed predominantly in the previous topic. This topic tries to aim, what is the name again? Capital structure. This particular chapter, no sir, is trying to find out the optimum capital structure. Like in a way you could say, what is the perfect capital structure so that the value of the firm is maximized? What should be the from what and all source you should raise the finance so that your value of the firm is maximum? Because especially when you are undertaking big projects, no sir, when you need like 10 crores, 100 crores, a lot of money, do you think people will raise the finance from just one source like equity, preference shares or debt, or they will go for a combo offer? Some portion of the funds will come from equity. Some may come from preference shares or some may come from debt. Yes or no? This chapter is trying to say how much weightage should be given to equity, how much to preference shares, how much to debt. Meaning equity should be 80%, preference share should be 5%, debt should be 50%, or equity should be 10, preference should be 10, debt should be 80. Like that, what should be this combination so that the value of the firm is maximized? That is what we are trying to achieve in this particular chapter. Okay, sir. This is the objective or overview of this particular topic. Can I move ahead? Sir, how do you select the source of finance? You already know this. We discussed in chapter number 1 itself. RCC as in risk, cost and control. This we already know of, right? You want me to go through this again, or that's fine? That's fine. So based on these parameters, you will decide which source of finance ideally you should go for. Done, sir. Now you know that when we did chapter number 4, you got to know that there are a lot of formulas to remember. So that means here also some more you will get, but a lot more easier ones, not the crazy ones we saw there. Okay, little easier ones. So the thing that we need to remember is 2 or 3 probably for today's class. That's good enough. Sir, value of the firm, which we denote it as V. So what is capital structure ka intention? Main intention is to increase the or maximize the value of firm. Value of the firm is given by EBIT divided by KO. Are we comfortable with this KO? As in overall cost of capital. EBIT means earnings before interest and tax. Or you can also call it as PBIT, as in profit before interest and tax. So take this divided by overall cost of capital will give you the value of the firm. Okay, next 4 or 5 problems we're going to be doing, and probably today's session is just going to revolve around one is this and maybe another equation. If you know that, then more or less things are set. Done, sir? Okay, let's understand this a little more. So we know how to find out the value of the firm. This much if you know for exam, that is good enough. That is EBIT divided by KO. Now, sir, to start any business, you need capital. Correct? No? So let's say the capital is 10 lakh rupees. Okay, you've started a particular business with a capital of 10 lakh rupees. And if you're starting any business means, are you going to do this just like that, or you will have some return percentage in mind? You will expect, no, maybe 10, 20, 50, 40, whatever. So let's say, sir, you are expecting the return percentage of 15%. From this particular business which you have started, you are expecting a return percentage of 15%. So you have invested 10 lakh to do a particular business, maybe your own funds, not somebody else's. Your own funds you have invested and you are expecting a return of how much, sir? 15%. Can you help me with the return amount that you are looking for? 1 lakh 50,000. Basically 10 lakh multiplied by 15%. Yes or no, sir? So the return that you are looking for is 1.5 lakh rupees. Any problem in this calculation? Anybody? No? Easy, straightforward. Online also good? Okay. Sir, if I give you the return amount, if I give you the return percentage, can you compute the capital for me as an equation? So tell me the capital as an equation here, sir. Capital is equal to what, sir? Return amount divided by return percentage, correct? Yes, just altered the equation slightly to get this particular thing. Sir, capital in FM terminology means what? Or here, 1 minute, hang on. Excuse me. All right. So now maybe just keep this formula in mind. What did we learn just now before this formula? How do you get the value of the firm? EBIT divided by overall cost of capital. So return here means EBIT. Return percentage here means overall cost of capital, because for an investor it is a return, for a company it is the cost. And you have one source of finance or multiple source. That means will you take only cost of equity, cost of debt, or overall cost of capital? That means instead of return percentage you will take KO. So when you do that, you're going to get the capital. Capital is nothing but what, sir? Total finance. Yes or no? Total finance here include both equity, debt, and this thing. If you sum up everything, that only we're calling it as value of the firm. That is how this particular formula is derived. You don't have to know all this. All you need to know is how do you get the value of the firm, which is nothing but EBIT divided by overall cost of capital. Any problems, sir? With the first equation, anybody? This is the first one that we definitely need to remember. Okay. Another way, if I'm not hearing anything, so I'm thinking it's good. Another way you can structure this equation is value of the firm. Value of the firm. So primarily, how are you going to raise the finance? Equity shares and debt, can I say? Because on preference shares, you don't get the tax benefit. So instead of preference shares, people generally prefer to issue what? Debt. Yes or no? So value of the firm is also denoted by, or if you wanted another one, it's nothing but value of equity plus value of equity plus value of debt. Because you don't raise the preference shares, because on preference shares you don't get the tax benefit. See, think about debentures and preference shares. Like here, if it is a 10% preference shares, then how much dividend you need to pay on these shares? 10%. Sir, if it is a 10% debentures, how much interest you need to pay? 10%. Okay, na sir? Correct? This is the cost for the company. So on debentures, na sir, you will get tax benefit. That means the cost will reduce. But on preference shares, will you get tax benefit or no tax benefit? That means preference shares is lot more costlier. That means now you tell me, if you are as a finance manager will prefer to issue preference shares or debentures? Debentures. That's the reason we don't take preference shares in these equations, because debt plan we say will dominate the preference share ka plan. Because on debt plan you will get the tax benefit. That's the reason. Yes, sir. So another way, if you want it in alphabet notation, it is written as value of the firm is nothing but S plus D. Value of the firm, they call it as S plus D. S here stands for value of equity. Value of equity is denoted by the symbol S. Don't ask me why S. I did not do it. It's not Sandesh for sure. It's value of equity. Okay. D stands for value of debt. So add these two. So you're going to get the value of the firm. Then, sir, second one you need to remember. Maybe one more. I think we're good to.
If at all the company doesn't prefer preference share, why is there a preference?
No, there is an option part. Preferring or not preferring is another issue. Okay, some of them may still want to go through with it.
Desperate people.
Not necessarily desperate. Again, like see, it's there as a share, but practically have I seen much of preference shares? No, for a simple reason of this. Okay, or maybe like suppose they bring in a tax modification, saying maybe earlier, I don't know. I mean, this preference shares and all was there long before I was born, and probably it will be there long after I am gone also. Okay, maybe when the time it was introduced, no, on preference shares, you were getting tax benefit. I don't know. Maybe that is the reason this preference shares was bought in as a instrument in the first place. I have no idea about it. History. I'm just making a guess. But in today's terminology, debt is always better than the preference shares plan. Because at least so in India, at least. Because see, in India, we have a Companies Act which says that unless otherwise specified, preference shares are always redeemable, they are cumulative, and they are non-convertible. This is Companies Act 2013 ka provisions. Okay. That means I'm more stressing on the word cumulative. That means even if you don't have profits this year, next year you have to pay previous year arrears dividend also. You can't escape from it. Maybe in some countries, no, preference shares can be issued as non-cumulative. If you can issue preference shares as a non-cumulative preference shares, that means in the year you make profit, you will pay dividend. In the year you don't make profit, you may not pay dividend. So in that, maybe in some countries that is allowed. That's the reason probably preference shares as an instrument was bought in. Could be, I don't know any of these. I think the second one is probably a better guess. I don't know. I'm anyway just over here guessing. But in India, though, definitely debenture is preferred over the preference shares. That much I can say. Other countries, I have no idea, sir. Okay, people. Coming back here again. So again, the takeaway is what and all we need to remember. Value of the firm is denoted by the symbol V. And how do you get that, sir? Yes. EBIT, earnings before interest and tax, divided by overall cost of capital, KO. Done. And value of the firm is denoted by the symbol V. Another way to get it is S plus D. S as in market value of equity plus market value of debt. Done, Saru? Okay, sir. Sir. If you've got it now, you will be able to construct one equation for me for S, sir. If you got this equation, you will construct one equation for S for me, like one formula. Can full Dilkush shall become. Can you do that? No, not the, don't this. See this, I'm pointing out here. See this and construct one equation for me. I need S. EAT. EAT divided by cost of equity. EBIT divided by cost of equity. Biscuit divided by biscuit, last bencher. They're like wondering, online, EBIT by. You cannot minus. Who is that? Hey, follow, Guru, follow, Tarso. Just kidding. Tell, whatever you feel. Yeah, S. Just looking at this equation. You're not focusing on this equation. That minus D, this minus D, hey, that minus D now, what minus D now? Isha, huh? Not EB8. Okay, check here, sir. First of all, let's drop this equation. EBIT minus interest, if you do, what are you going to get? EBT. From EBT, if you deduct tax, what are you going to get? EAT. Okay, which we did solidly this afternoon. Afterwards, less preference dividend. From this EAT, if you deduct preference dividend, you will get one number, correct? Like maybe let's say this is 1, this is 10, this is 90, let's say I tax at 30%, 23, so this is 63, let's say this is 10. That means this will be 53. This 53,000 is available to whom? Equity share holders. S means what, sir? Market value of equity. Yes, sir. Now, can you pay equity dividend from EBIT? No. Can you directly pay equity dividend from EBIT, or first you have to deduct interest? First deduct interest. Then you have to pay tax. Then you have to pay preference dividend. Then only if company wants, they can pay equity dividend. In this, how much is available for equity dividend? 53,000. This we call it as earnings attributable or earnings available to equity shareholders. Correct, sir? This only we used to call it in AS20 terminology as EASH. Earnings attributable to equity shareholders. Yes, sir. Yeah, ish. They're liking that word. And then now they'll go on telling on the road, issue, push, on. Okay. Or indirectly they're telling issue to me, I think. Yeah. You keep it, we'll enjoy. Okay. So 53,000 is the ish or earnings attributable to equity shareholders. Or you can also call this as net income. Net income. Done, Saru? Now you tell. Now you're calculating market value of equity. Is EBIT available for equity shareholders? No. What is available? EASH. Hence the numerator will become EASH. Are we taking overall cost of capital or only market value of equity we are trying to find? If you're finding out market value of equity, you will only take cost of equity. Hence, that's the equation. So these three is what is required for today's session.
Yes.
Fine now, only these three. Remaining 5-6 problems are all around this one, this one, this one, this one, this one. Done, done, or done, G. Everybody okay, G? Move on, G. Online also, G. Parle G, correct? Parle G only, yeah. Okay, sir. So three equations, whatever we have done, we have given over here. Value of the form is EB80 divided by K, all that we have learned. Now look at this fancy one, super duper one. It will take half an hour to mug up this. KO is equal to KD into D divided by D plus S plus cost of equity into S divided by D plus CS. One more you need to remember, sir. Ayyo Rama. Crazy, no? Nothing else. Waste equation this is. Sir, have you calculated KO? First you used to write source of finance. Let's say equity and debt. Sir, equity is let's say 10, no? Or maybe this 40, this is 10. Okay. Equity is let's say this is book value. Okay, equity ka value is 40, debt ka value is 10. I've assumed. Total is how much, sir? 50. Next, what will you calculate? Weights. How do you calculate weights? 40 divided by 50, which is 0.8. Correct? Then it will be 50 divided by 10 divided by 50, which is 0.2. Correct, sir? Then how do you calculate overall cost of capital? First, you used to take after tax cost of capital. All right. Then if you multiply these two, you're going to get after tax cost of capital. Can I call it as cost of equity? Whatever this is, I'm just representing in symbol. Would you be fine? And this will be cost of debt. Done, sir. If you multiply these two and add it up, you used to get the overall cost of capital. That's what we have done in many questions. Do you agree with me? Okay. Check the screen, everybody, for a minute. So just now we learned debt to equity, and this will make it as market value. What do you call equity here? Symbols. Market value of equity is denoted by the symbol S. Market value of debt is denoted by the symbol D. So 40 plus 10 is nothing but 50. That is nothing but S plus D. Correct? Okay, na sir? That is V. Fine. Done. Now calculate the weights for me with the help of this alphabets. With number you calculated weights, no? Same you calculated in terms of alphabets for me. S divided by S plus D. Correct? Then how do you calculate overall cost of capital? This. You will take cost of equity here. So what will be the symbol? Tell me, sir. Cost of equity into S divided by S plus D. Yes, sir. Any problem? Okay. Now calculate the weight of debt for me, sir. How do you calculate that? 10 divided by 50. 10 is denoted as D over here. 50 is denoted as S plus D. Okay. Then you will take after tax cost of debt denoted by the symbol KD. Yeah. Alright. Then how do you get overall cost of capital? KD multiplied by D divided by S plus D. Fine. If you total these, then only you will get overall cost of capital. Now look at this symbol. K was given by what? Cost of equity into S divided by D plus S. What is this, sir? This is the weight of equity. Here is what? Cost of debt into debt divided by debt plus S. This is nothing but what? Weight of debt. That's all, sir. Instead of we did all this in numbers, they've expressed this in equation or in alphabets. That's all. So that means, is this really a formula which we need to mug it up, or we know this? You know this. Just that now we'll have to, if at all, I don't think so, you'll need to remember this and apply it to any of the problems. If at all they ask such things in MCQ question, can you fill up the blanks or select the right answer? That is all. not break, just processing time. Okay, just one recap let's quickly have, and then we'll move on to some theory. Okay, the chapter name was capital structure. So what are we trying to do over here? Find out the optimum capital structure so that the value of the firm is maximized. And value of the firm is denoted by the symbol V. So how do you get V, sir? EBIT divided by overall cost of capital as in KO. Or another way to represent it is V is equal to market value of equity denoted by the symbol S plus market value of debt divided by the symbol D. So V is equal to S plus D. If you want to get market value of equity alone, you can rephrase that equation to be, instead of EBIT, you will take EASH or net income divided by cost of equity. That's all we have learned so far. Okay, so now we have a little bit of theory around this, may get asked as an MCQ question, but after 2 minutes, hardly struck some structure theories, and then we will dive into the problems. Sir, capital structure has some theories, meaning we are trying to find out optimum capital structure. No? Okay, so there's some theories built around this. First is relevance theory, and then we have some irrelevance theory, like our classes. Okay. Some relevance theories and some irrelevance theories. So we'll take up first the relevance theory. What does relevance theory, or what does the word relevant mean? Important or necessary, yes or no? So relevance theory ka argument is, sir, how you choose your capital structure, no? Based on that, value of the firm will change. Meaning, if you say debt is 80% and equity will be 20%, that means the value of the firm could be 10 lakh. If you use this combination, maybe value of the firm could be 10 lakh. If you change this structure, let's say you make this 50-50, then the value of the firm will not be 10 lakh, it will become something else. Maybe it will be more than 10 lakhs or less than 10 lakh. That is what is the argument relevance theory is putting forth. Meaning, based on your source of finance, the value of the firm may increase or it may decrease. That's the overall. Did you get the understanding of relevance theory? Ka? Okay. Under relevance theory, no, sir, there are two. One is the net income approach and traditional approach. Net income approach and traditional approach both are relevance theories. Net operating income approach and Modi-Giuliani-Miller approach is irrelevance approach. approach will keep it. Modi, Miller approach. Narendra Modi. Fine. We never know. It could be renamed also. A lot of power is there. Okay. Yeah. So for now, we'll keep it as approach. Fine. So, but these two, first two comes under relevance approach. Second two, or the last two comes under the irrelevance approach. So like this also an MCQ question can be found. Which of the following is which of the following is not a relevance theory? They can give any random four, one of them could be the right option. Like with the MCQ, no, any line can also be made as a question. So you will not be able to figure out what is important, what is not important. That is one of the drawback of an MCQ pattern, which is probably why Institute is pushing for that pattern so much. Because still now in old syllabus, we never used to bother about all this. Because we knew capital structure means 7 marks practical question will come. This and all patapat we could do. Because we know that all this, how much ever you spend, exam relevance is not there. So why spend so much time? Yeah, irrelevant. Yeah. No, but everything has become now relevant. Okay. I'm not saying every line can be made as an MCQ question. Few 2-3 marks MCQ question can also be a little trickier because they can structure like these also, which nobody can plan or prepare for that matter. You can only hope for the best. Like that. That means go in, sir? No. Not go in. Exemption only. Don't worry. Okay. Coming back to the first relevance theory. Sir, what is the first relevant theory? Net income approach. Listen to this carefully. There are a lot of words. I've written the right contents in the chart book, which I'll just bring it up here also. No need to write down anything. Just if you listen, that's good enough. Valid on only. You don't have to mug up anything. I'll just prove it to you with certain numbers also, so that you'll remember what to those words trying to say. Sir, net income approach. So first of all, net income approach is R or IR. It's an R, as in relevance approach. So what net income approach says is, cost of debt, or rather debt is cheaper than equity. Just listen. Whatever statement I'm making, see whether you agree with me or not. This particular approach is saying debt is cheaper than equity. Is the statement right? Debt, cost of debt is lesser than cost of equity. Is that so? Yes or no? No. We already discussed this in initial chapter also, no, sir. Risk, cost and control. All right. See, from investor perspective, you think investing in debenture is risky or investing in equity share is risky? Investing in equity shares is very risky, yes or no? Because if you invest in some company called debenture, you will get fixed return every year or every month. That means you are taking more risk as an investor or less risk? Less risk. That means your expectation also will be little lesser. But when you invest in some company called equity share, you are taking a lot of risk because you are not getting any dividend also. You don't know whether you will get your money back also. So that means you are taking a lot higher risk. So the expectation of return also will be on the higher side. Yes, no, sir, everybody? Okay, yes, or no? That means what? Debt is cheaper than the equity. Agree? Because cost, we already discussed. Cost here does not mean the actual cost. Cost here refers to the expectations of the providers of finance. Equity shareholders expect a higher return. Even if you don't give them dividend, they expect the market price of the share to go on increase. So that way their expectations will be a lot higher, which I think we discussed in chapter 1 also. I told you this. Yes, so okay, statement is right then. Debt is cheaper than equity. That means cost of debt will be lesser than cost of equity. First one. So what this particular theory says is, since debt is cheaper, you go bonkers, meaning use as much debt as possible, because more and more debt you use, overall cost of capital will reduce. KO is overall cost of capital. No? More and more debt you use, overall cost of, I'll prove it to you with numbers, don't have to worry, okay? The more and more debt you use, overall cost of capital will reduce. So, and your value of the firm will increase. That is what the argument this particular theory is trying to put forth. Again, I'll tell it to you in words and then we'll take up the numbers. One is debt is cheaper when compared to equity. Since debt is cheaper, okay, then that means overall cost of capital is on the lower side. Meaning overall cost of capital reduces as you increase your debt portion. Since KO reduces, the value of the firm will increase. Can we prove it in one of the numbers, sir? Some random numbers we'll take. Okay. Source of finance, equity and debt. Or maybe first we'll start with debt. So let's say we were doing 50-50, meaning 50% of the weights was from equity and 50% of the weight was from debt. This was a combination that a particular company was using. Then how do you get overall cost of capital, sir? Weights multiplied by after tax cost of capital. I'm going to assume that cost of debt is 10%. Assume the number. Do you think cost of equity will be 10 only or it will be more? More, because the expectation of providers of equity finance will be on the higher side. So I've assumed this to be 15. Just assume the numbers. Calculate KO for me, sir. This is these two come multiplication 5. These two come multiplication 7.5, which is 12.5. Any problem? Just some random numbers ka calculation. Done now. This is the existing one. Existing capital structure. Now, no, sir, the firm wants to modify the capital structure, a new capital structure. You know what they want to do? Debt, no, sir, they want to go 90%. Equity, they want to use only 10%. They want to change from 50-50, they want to make it 90-10. Okay, let's see what happens. Okay, so this is the weights and after tax cost of capital. Let's take it as same. How much I assumed here, sir? 10, and here it is 15. Calculate KO for me here. 9. 1 point. Okay. How much is this? 10 point. Earlier, how much was KO? 12.5. Now, how much is KO? 10.5. What did I say? First equation, just check here. Debt is cheaper when compared to cost of equity. More and more debt you use, overall cost of capital will reduce. That's what I wrote in second point. Did it reduce? Earlier, overall cost of capital was 12.5. Now it became 10.5. That means it reduced. Why? Why? Because earlier you were using only 50% of debt. Now you have how much money you are taking from debt? 90% you are taking from debt. That means debt ka finance have you reduced or have you increased? If you increase the debt ka utilization, your overall cost of capital will reduce. Have I proved this equation for you? Any doubt anybody is having here, sir? Okay, sir, if overall cost of capital reduces, no, value of the firm will increase. Okay, let's calculate that also with the help of same numbers. Sir, how do you get value of the firm? Just now we learned EBIT divided by K. Sir, let's say EBIT was 1 lakh rupees. EBIT was 1 lakh. How much for existing capital structure? How much is KO, sir? 12.5. This is 12.5 percentage. 12.5 percentage. If you want to express in number, it will be 0.125. So how much is value of the firm? Huh? 1 lakh divided by 0.125. 8 lakhs. Okay. This is the value of the firm under existing data, sir. Alright. Now let's calculate the same value of the firm under the new data. EBIT is 1 lakh divided by overall cost of capital is how much now? 10.5%. That means it will be 0.105. How much will be this? 9 lakh? One number, 1 lakh divided by 0.105, which will be 9,52,380. From 8 lakh value of the firm became 9 lakh. So it increased or reduced? It increased. What have I written over here? Value of the firm will increase. Basically, this cost of capital and your excuse me, and your value of the firm has an inverse or ulta relationship. If cost of capital reduces means value of the firm will increase. If cost of capital increases means value of the firm will reduce. Now we have numbers to back that. Any doubt, sir? So this is what first relevance theory is trying to say. Since debt is cheaper, if anybody wants to increase the value of the firm, simple action plan they have to take is start using more and more debt. More and more debt you take, value of the firm will go on increasing. That is the argument this theory is trying to put. That is what we have written here. Any doubt to or got it too? Don't need to write down anything. I bought all these relevant points in the chart book only. So that much if you remember and write it, that should be good. Same thing, whatever I've written here, I've just got it there also. Okay. That should be okay. Can I move on to the next one? Okay, so first one we studied, that is net income approach. Second one is the traditional approach. We'll do up this theory first, 3, 4, and then we will dive into the problems in one shot. It'll be a little easier. That's fine by you, no? That means 5 minutes you're going to sleep off? No, right? We're going to be awake, alive and awake, both. Yeah? Okay. Okay, next one is the traditional approach. Traditional approach is also what, sir? Relevance theory. What traditional approach says is, boss, listen. Debt may be cheaper, but use equity and debt judiciously or carefully. Use equity and debt carefully. What is this approach trying to say is, yes, cost of debt initially will be cheaper. When compared to equity, cost of debt will be cheaper. But just because it is cheaper, if you go on taking loans, just because loan is cheaper, you went to every bank and started asking loan. 1 crore, 10 lakh, 50 lakh, 50 crore, like that, you approached every bank. Sir, maybe first two banker gave you the loan at good rate, or let's say like this. You've already taken a 10 crore loan at, let's say, 8%. Compared to your business size, 10 crore loan is already big. After 3 months, you went to the banker and said, I need another 15 crore loan. Now, do you think the banker will give you the loan at 8% only? No. Because compared to your business size, the loan amount is very high. I mean, the risk the banker will feel is, banker now will be buka. Okay, he may be earning interest, but he's also worries whether you will put repeat toss to him. Okay, pay EMI for 4-5 months and then just go to an abroad like that. So, are you that person's shishya or not? He will have worry, correct or no? So that's the reason when when you take a lot higher loan, banks will start feeling the risk. Now he may sanction the loan, but not at 8%. He may increase it to or maybe 12%. That means what is the argument this traditional approach is trying to say is you should use both of them judiciously. Okay, because initially cost of the debt may be less. If cost of the debt means overall, if cost of the debt is less means overall cost of capital also will be less. Value of the firm will increase. Agreed up. This will happen up to a certain point of time. Meaning up to a certain point of time means when the loan amount is maximum up to 10 crore in my example. Yes or no? When the loan goes beyond 10%, then what happened to the cost of debt? Is it same 8% or increased? After some point of time, cost of debt will increase. That means what happens? Overall cost of capital also will increase. Value of the firm will increase. That is what this approach is trying to say. That's the reason you need to use the debts carefully, not left, right, center. Ujjading is not allowed. Okay, sir. That is what this particular component funda is all about this. No, not even one thumbs up. Hey, thumb vidya. You can give one no. You're writing, No, sir. Huh? Okay, or if you want it another way also we can think about it. All right. Sir, if you take more and more debt, that means on debt you have to compulsorily pay EMI or interest. Correct? No. That means if you take more and more debt, the business will become more and more risky. Agreed? Because whether company has profit or not, interest to the debt guys has to be paid. Because if you take more and more debt, that means the risk of the business will increase. That means equity shareholders will be full chilla. Sir, if business becomes more risky, will they expect same return or will they expect higher return? So if you take more and more debt, when business will become more and more risky, so the expectation of equity shareholders will increase. So cost of equity will increase. If cost of equity increases means overall cost of capital also will increase. Value of the firm will increase. One of the two will happen. If you take more and more debt, the next debt will be given at higher rate, which will reduce the value of the firm, or obviously the expectation of equity shareholders will increase, which will bring the value of the firm downfall. That is what the argument this particular traditional approach is trying to say. Hence, you need to use equity and debt judiciously or carefully. Ashte sir. This may be asked as an MCQ question. They'll not ask you probably a straightforward question, explain this and all. Doubtful. These sort of presentation may be asked. This happens, what will happen to value of the firm? Those sort of MCQs, if they want. I've not seen it in any of these existing MCQs that we have in material so far, but might get asked. I have absolutely no idea. But did you get an idea about this now? Can I move on to the next one, sir? Yes, sir. Okay. Sir, next is net operating income approach. Net operating income approach, which comes under relevance or irrelevance theory. Irrelevance theory. Now, listen to this. What net operating income approach is? First of all, it's what sort of theory, sir? Irrelevance theory. What this irrelevance theory argument is, you can do whatever you want. You can do whatever you want. Value of the firm will not change. You go for 90 debt, 10 equity. You go for 50% debt, 50% equity. 80% debt, 20% whatever. The value of the firm will be same. That is what irrelevance theory argument is all about. Basically, they are opposition party. The other guy is saying value will increase or decrease. This party is saying value will be same. Just like us. Okay, it will be same. It will never change. Argument of net operating income approach is same thing. The moment you take debt, debt is no doubt cheaper source of finance. But the moment you take debt, okay, so cost of debt is cheaper, overall cost of capital will reduce. So that means value of the firm will increase. Their argument is the moment this happens, the moment you take debt, equity shareholders will start feeling buku buku. I mean, since the business has become risky, expectation of equity shareholders will immediately increase. It will not happen after 5 years or 10 years. The moment you take debt, equity shareholders will find the business to be risky and their expectation will automatically increase. If cost of equity increases, overall cost of capital will also increase. Therefore, value of the firm will reduce. That means these two will happen simultaneously. That means one will lead to increase in capital or increase in the value of the firm. Other will correspondingly bring the value of the firm. That means value of the firm will be unchanged. That's their argument. So which is right, sir? No. In fact, there is no magic formula. It all depends on industry to industry, company to company, scenario to scenario, year to year rules. So all these are not actually what? No magic formula that this is best to, that is best to and all that stuff. Like your income tax you might have studied, no? Like income tax officer disallowed one expenditure, ITIT might have allowed it. Or ITIT might have disallowed it, High Court or Supreme Court may allow it. Does it mean that mean ITIT person is wrong, Supreme Court person is right? Or just a perception? Perception. Scenario would have changed, correct? No? The way of argument, the person who was argued, the facts, etc., everything would have, dynamics would have changed. This also like that. It's not like this is right, that is right. It's all about the way you look at it and when you look at it, in which scenario you are analyzing it. So it depends on that. So it's not about left or right. It's just about knowing for exams. That's all. Okay, now. Okay. Jaideep, you got this so much, huh? The first one. This one. Debt is cheaper. This much you got, huh? Debt is cheaper. So since debt is cheaper, overall cost of capital will reduce. We know that cost of capital and value of the firm have an ulta relationship. If this reduces, value of the firm will increase. Okay, you're saying this, you have got it. No problem. I'll take it from there. So the moment you take debt, no sir. The moment you take debt, business, you tell me sir, is less risky or more risky? The moment I've borrowed or if I've issued any bonds or debentures or if I've taken any bank loan, my business will be same risky or less risky or more risky or no impact on risk. What do you think? Less risky ada. Ayyo, inna macha ipdi sollite. The moment you take debt, the business will become more risky, no macha. Not risk da, risk. The business will become more risky, no da. Because see, if I take debt means on that debt I have to pay interest. Let's say I pay the interest every month. I pay the interest monthly. Whether I make profit or I don't make profit, I have to pay interest or can I escape from it? Whether I make profit or not, I have to pay this interest. Correct or no? That means the moment you take debt, no one fixed obligation will come on your head. That is to pay interest and periodically you have to redeem also. This debt, whatever you borrowed, let's say you borrowed a loan of 10 crore rupees. Loan forever, can you keep it or you have to repay it? That means two obligations comes on your head. One is to periodically pay interest. Another one to repay the debt amount, redemption. So that's the reason the business becomes more risky. The moment business becomes more risky. Now you tell Jaideep, you invested in RBI bonds, you invested in cryptocurrency. Both you will expect same return. Huh? RBI gives 7% return. On crypto, will you expect 7% return yearly? No, probably you will expect 10% return daily. Because you are taking full risk, yes or no? Same like that. Once the business becomes more risky, equity shareholders in the business, no, they will not expect same return. They will start expecting higher return. So the moment cost of debt increases, more debt you take, expectation of equity shareholders will start increasing. So cost of equity will increase. So that will lead to overall cost of capital will increase. Since overall cost of capital increases, value of the firm will reduce it because of ulta relationship. These two will happen simultaneously is the argument this particular theory is putting forth. Since these happen simultaneously, if one increases the value by 1 lakh, another one will correspondingly decrease the value by 1 lakh. That means the value will be same or unchanged. That's what we meant. Now, okay, na Saru. He's saying, got it. Anybody else, anything? Like, oh. Okay, then we'll do some problems. Maybe better. Then maybe 1 or 2 theories we'll take it at the end, maybe. Okay. Oh, there are Good only, no? Okay. Okay, let's see how much of it actually you remember. All of you nodded. Give me one breakup. One recap. Or it's that for my man ki tasalli ke liye. Okay? Chapter name. Abba, capital structure. Okay. So that is trying to find out what's which source of finance ideally you should select or how you should select so that the value of the firm is maximized. Okay. So under this we saw a few equations. Value of the firm is denoted by the symbol V is given by EBIT divided by KO, overall cost of capital. Okay. Value of the firm is also given by market value of equity, that is S, plus market value of debt, which is D. If you want to find out market value of equity, S alone, it is each or net income divided by cost of equity. Okay, those three we saw. Then under this particular capital structure, we saw some relevance theory, irrelevance theory. Relevance theory means you can play around your source of finance and you may increase or you may decrease the value of the firm. So under relevance theory, first thing we saw was net income approach. What does net income approach is? Go nuts. Debt is cheaper, so use debt as much as possible. If you use as much debt as possible, overall cost of capital will reduce, which will make the value of the firm to increase. That is the argument. Then traditional approach. Traditional approach is little traditional. Use the equity and debt little carefully or judiciously because up to a certain level, debt is cheaper. So value of overall cost of capital will reduce. Value of the firm will increase. Afterwards, the moment you take a debt beyond a certain point of time, debt lenders will not give you at same rate. They will start expecting higher rate. That means the cost of debt will automatically increase, which will increase the overall cost of capital, which will decrease the value of the firm. So corresponding ulta effect will happen in a few years down the line. That's your traditional approach. Then we went to irrelevance theory. Under irrelevance theory, we saw net operating income approach. Irrelevance theory or theory's argument is you do whatever you want, value of the firm will not change. It will be same. Their argument is debt is cheaper. So when you take more and more debt, cost of debt will reduce. So overall cost of capital will reduce. Value of the firm will increase. But the moment you take debt, business will start becoming more and more risky and expectation of equity shareholders will automatically increase. So this happens, so correspondingly cost of equity will increase, overall cost of capital will increase, which will lead to a downfall or reduction in value of the firm. That's all. Yes. Problem. Come to question 1. Rupa's EBIT. Okay. Question number 1. Rupa's EBIT is 5 lakh rupees. So we need EBIT. We know what for. Company has 10%. Aram ka mamla it seems. Okay. Okay. EBIT is 5 lakh. Company has 10%, 20 lakh debentures. So okay, sir. Cost, the interest rate on debentures is how much? 20%. So how much is the value of debentures? 20 lakh. Equity capitalization rate, cost of equity is how much? 16%. You are required to calculate market value of equity, which we know is denoted by the symbol S, and value of the firm denoted by the symbol V. Overall cost of the capital denoted by the symbol A. That's all. 3 simple requirements and we are done with the problem only, not class. Class will get over after one more problem. After that, loop already the class. Enough, sir. Republic Day, sir. What, sir? Okay, sir. Republic Day, no. So 4 or 5 problems extra will do. Either he Jai Hind, okay? Yeah. Okay. So if you do today extra, Sunday we'll have some maybe relaxation. That did. You are all today, we'll see Sunday later. Then Sunday you'll start saying the same thing. Monday we'll see something. I not believe in procrastination. We'll do it here only, today only. Okay, can I come back to all like 5-10 minutes question? That's all. Not big questions. These are all very simple. In fact, to be honest with you, one if I solve, next 3 questions literally homework. Same thing asked in a different way. 5 minutes mein fatafat we can finish it off. Okay, so let's finish today's target by today itself. Yeah, not by 7, 8. Today itself, whatever. Okay, again, people, let's listen. One problem you understand. Next one, if you want in the interest of time, we can tick it also. I have no issues with that. It's the same. So they have given what's an EBIT. They have given cost of equity. You know the debt value? Yes. You know the interest rate on debt? Yes. Requirement is just to calculate S, market value of equity, value of the firm V, and overall cost of capital. Okay, let's start. Question number 1. So the first requirement, we want market value of equity. The number is anything? No. Market value of equity. Denoted by symbol what, sir? S. Sir, tell me, sir, how do you find out this S? So EBIT na. Ish. Actually, no, don't use the term maybe ish. Ish is something which we probably use in AS20. So instead of maybe for 1 or 2 problems to connect with, you can write ish. Start writing net income. Maybe that is better. Would you be fine? Huh?
Tax rate is not given.
No, I'm writing the formula. So if it's not given, don't say 30% at all. Not required. We'll see. Huh? S is equal to ish or net income divided by what, sir? Cost of equity. Yes. Fine now. Sir, have they given net income to us in the problem, or we need to find out? We need to find out. Sir, what have they given in the problem? EBIT. So maybe we'll give the heading here as net income. Have they given EBIT in the question? EBIT stands for earnings before interest and tax. How much is that EBIT? 5 lakhs. Okay. From EBIT, how do you get each, sir? First, we have to do what? Deduct interest. Do you know the debt value? Yeah, debt value is 20 lakh. What percentage interest debt carries? So 20 lakh into 10%, which is 2 lakh. So take after tax interest, sir. Sir, ish and all, no, sir, is accounting ish. Ish or net income is as per your P&L. In your P&L, when you do the accounting, did you deduct after tax interest? Or what do you do? You normally, whatever is the interest deducted, after that you calculate the tax separately. The effect is same finally, but don't directly do interest into 1 minus tax rate. Do it, show it separately. Fine now, people? Everyone okay now? Alright, so if you do EBIT minus interest, what are you going to get, sir? Earnings before. One problem, maybe we'll write the full forms. Short forms are acceptable in exam, it's okay. But just for some of them may not be comfortable, so we'll write the full form as well. So earnings before taxes, how much, sir? 3 lakhs. Sir, this L and all is acceptable, sir?
No, sir.
Absolutely no. Why are you writing, sir? I think I already told you that. Yeah. Tax given or not given? Not given. Sir, I'll assume 30%, sir. That's my favorite number. Not required. If they give the tax, take it. Otherwise, don't take it. So, but 30%, no, sir. Not necessary. You have studied tax. Everybody is taxed at 30% or differs from individual slab rate, okay, and corporates, the 30%, and we have surcharge separately also, certain conditions. So don't judify or bring in tax element there. If they're given tax rate, take it. Otherwise, simply take it as 0. So what is earnings after tax, sir? 3 lakhs. Okay, or maybe this also will write full. Earnings after tax, which is EAT, is 3 lakh. From this, what do you do? Is this net income? No. From this, you'll have to deduct the preference dividend. Sir, have they given any preference dividend in the problem? No. That means here, if you do, you're going to get the net income, which is NI, or you can call it as ish, which is how much, sir? 3. This we want. So in exam, everything which does not have value also we should write as, sir. Sir, if tax is not there, preference dividend is not there. That means earnings before tax itself is ish. So here only you can write EBT slash net income and stop it there only. Done now. But first problem, I'm showing you the full calculation. In exam, you can write it as ish and put an end there, not required to go further. Done, done, G. Okay, this one you have got it, G. All right. So the first number for market value of equity we have got. Next number, what do we need, sir? Cost of equity. Cost of equity we have to find or given. Cost of equity is 16%. So therefore, can you tell me, sir, what is market value of equity? Net income divided by cost of equity. Net income is 3 lakh divided by cost of equity is 16%, which is 18,75,000 is the market value of equity. Any problem, anybody till here? Yes. Okay, then sir. Next, what have they told? Value of the firm. Here only we'll find out. Value of the firm is denoted by the symbol V. How do you get that? Either you can get EBIT divided by KO. KO have they given? No. That means we'll use another one. Value of the firm is given by S plus D. S is what, sir? Market value of equity plus D is market value of debt. Market value of equity just now we found out to be 18,75,000. Market value of debt is given to us in the question, which is 20 lakhs. If they don't give whatever is the debt value, same thing we'll take it as market value, because the debt instrument need not be compulsorily traded in the market. Okay, if they don't specify any specific market value, whatever value is given for a debt, that itself becomes what, sir? Market value. How much is the value of debt given in the question? 20 lakh. Same thing will become market value of debt itself. So how much is value of the firm? 38,75,000. First requirement is fully done. You also feeling so busy in copying? So okay. You want me to show from the beginning? Anybody? Yes, sir. Yes, sir. We were aram se chilling, sir. Understanding, no? Okay, those of you who are done can try to attempt the next one if possible. Could be, don't know. 12.9 seems to be the right answer. 12.9 is the right answer for the next requirement. Correct. Perfecto. Perfect. Can't be more perfect than that, I tell you. Okay, next. What is the next requirement, sir? Calculate the overall cost of capital. Sir, how do you get overall cost of capital? So first of all, how do you get value? First, they're asking the requirement KO. So which particular formula uses KO? First, figure out that. Value of the firm is given by EBIT divided by KO. Sir, if you know value of the firm, if you know EBIT, can you find out KO? Therefore, you can revise this formula as what? KO is equal to EBIT divided by V. We can cross multiply or rephrase this equation like this to get the KO. Yes or no, sir? So how much is EBIT? They gave in the question. EBIT is given in the question to be 5 lakh. Value of the firm, we just now got it to be 38,75,000. So KO is equal to what, sir? 0.1290 or 12.90%. That's all. If you're done, the very next question. Homework, but we will practice it here only. Okay, perfect. Let's go for the second question. Okay, listen up, people. Even if you're done, or you can try the next one. Although I think first 4 questions all are similar type. If you're done, you can aram do it the next ones, but be a little quiet. That's all. Some of them would have not got it. That's the reason. Let's bring everybody up to same pace. Indra's EBIT is 1 lakh. Company makes use of debt and equity. Firm has 10% debentures of 5 lakh. What is this 5 lakh, sir? Market value of debt. D. Firm's equity capitalization rate is 15%. Same like the last problem, you need to find out the value of the firm and overall cost of capital as in KO. Similar one. In fact, same, only numbers they've changed. That's all. Okay, so first requirement is value of the firm. All right, sir. So what is given in the question, sir? EBIT. Okay. EBIT is how much? 1 lakh. Sir, there are two ways to get value of the firm. One is EBIT divided by KO. Have they given KO? Have they given? If they're given KO, we could have used it directly. That is not there. Another way to get it is V is equal to, value of the firm is equal to market value of equity plus market value of debt. Market value of debt you already know, given, which is 5 lakh. Market value of equity can we find out? Yes. How do you find out? For that, what do we need? We need EBIT or we need ISH? ISH. How do you get ISH, sir? From EBIT deduct interest. So debt is 5 lakh, interest rate is 10%. 5 lakh at 10%, yes to grow 50,000. So from this, if you do, you're going to get earnings before tax, which is 50,000. Do we have any tax rate here? Any tax rate adjustment given? No. Sir, if tax is not there, then EB, EBT, EAT, ISH, all this will be same. Should you have to fill up that format or directly can I write net income here? So I'll write over here if you want. EAT/net income is the same, which is 50,000. Would you be okay? Because no further adjustment like tax, preference, dividend is given in this question. If it was given, we would have deducted those respective numbers also. Sir, how do you get market value of equity now? Net income divided by cost of equity. Net income, just now we got it to be 50,000. Cost of equity they've given in the question to be 15%, which is 0.15. So that gives us how much as S? 3,33,333 is the market value of equity. How do you get the value of the firm? S plus D. S is 3,33,333 plus debt. They've only given it to be 5 lakhs. So market value of the firm is 8,33,333. Great. Same as last question, no change. Finished off. Okay, what is the next requirement, sir? After value of the firm, we want overall cost of capital, which is KO. Okay. Sir, which formula uses KO? Value of the firm, which is nothing but EBIT divided by KO. Do you know the value of the firm? Yeah, just now we have got it. In fact, how do you find out here? Therefore, overall cost of capital is what, sir? EBIT divided by V. I'll rephrase it. EBIT is 1 lakh given here only. Value of the firm, just now we got it to be 8,33,333. So value of the overall cost of capital is 0.12 or 12%. Not going fast, no people. Everybody are there, I believe. Writing speed, if someone is lagging behind, you need to increase, guys. Finished. Okay. Everybody is saying finished. Here, anyone lagging behind wants wait or next? Next. All right. Question number 3. Determine the optimum capital structure from the following information. Listen to this. Easy question. Just observe. 2 minutes may we can, in fact, we can tick off this also. If you want it, just listen. They have given various options here. Different scenarios. Each are independent. And the first case, cost of debt is 11%. Cost of equity is 13%. Percentage, listen to this word carefully. Percentage of debt on the total value, meaning debt plus equity. What is this? Read this line once again and tell me. Percentage of debt on total value. Total value is given by debt plus equity. What is it? Perfect. Sir, this is nothing but weight of debt they have given. Okay, now that is what they're saying to say, because see what they're trying to say is D divided by D plus S is what they have done. That's what they say. Percentage of debt on total value. Total value is derived by debt plus equity. So basically, this is the weightage of debt. Weightage of debt is 0%, it seems. That means in the first option, are you using any debt or no debt? No. So that means how did they give cost, sir? Sir, cost refers to actual cost or expectation. Expectation. If you want to raise the debt, you need to give 11%. Is it necessary you have to, or you need not raise also? You need not raise. In the first case, have you raised any debt? No. That means you have only raised what? Entire finance of yours is from equity. Shh, guys, at the back. 5 minutes. Shh. All you need to find out is, sir, you need to find out the optimum capital structure. We know this already, sir. If the overall cost of capital reduces, value of the firm increases. Yes, no? That means using all this, no, under all the options, we just need to find out K. Under all the 7 options, we need to find out overall cost of capital. Whichever option gives the highest KO or lowest KO. Choose that option which has the lowest KO, because the lowest KO implies the highest value. That is your optimum capital structure. That's all. One line may you'll have to work out. No need to put up that fancy table and work it out. We anyway do overall cost of capital. No need to put up fancy table. We'll do it in one line. Can we do so, sir? Everybody got the question in the first place? Okay. So first scenario mein, question number 3, first scenario. Sir, what is the percentage of debt? 0. So first of all, tell me in equation if you want, how do you get overall cost of capital based on our own understanding? KO is equal to weight of debt. Can I write WD over here just for our simplicity? You can also write it as S divided by D plus S and all, or simply I'll write it as weight of debt. Would you be fine with that? Yes, no, our own formula, not class, just for remembrance sake. Fine, sir. You don't have to write any formula in these sort of questions. You can directly start solving. Only for our reference, we are constructing. So how do you get overall cost of capital? Take the weight of debt multiplied by the cost of debt. Correct? Plus what? Take the weight of equity multiplied by the cost of equity. Those are the only 2 we have. Under all the options, can we work out all this one by one? So first, option number 1. Overall cost of capital is equal to, sir, what is the weight of debt? Weight of debt in the first option is 0 plus cost of debt. What is the cost of debt? 11. Sir, if the weight of debt is 0 means the weight of equity will be 100%. 100% if you have to express in whole number, it will be 100 divided by 100, which is 1. Multiplied by cost of equity, which is 13%. I'll express it in percentage only so that I don't have to convert it once again. Fine now. If you want to play it in decimals, you can, but later again you'll have to convert that decimal into percentage. So that means what is this, sir? 0 plus 13, which is 13%. Any doubt, anybody in this first? Like this, we'll have to work it out 7 times. Can we fatafat do it? Guys, give a confirmation. Okay or what? Copying part, it's okay. Understanding wise is going good. Yes, sir. Time only going bad, sir. Okay, fine. Option online also once confirm, pa, just to be on the safer side. Okay. Option 2, overall cost of capital. Sir, in the second option, all these are independent. Okay. In the second option, what is the debt ka weightage? 0.1, as in 10%. So the weight of debt in the second option is 0.1. What is the cost of debt in the second option? 11. Sir, if debt ka weight is 0.1 means total weight should always be 1. If debt ka weight is 0.1 means equity ka weight will be 0.9 or 90%. Yes, no? So what will be the cost of equity under second option? Cost of equity under second option is 13%. So how much is this, sir? 12.8 after adding you're telling, no, full number. Okay. Total solution is 12.8%. Option 3, overall cost of capital. Cost of debt is, or rather weight of debt is 0.2. What is the cost of debt in third option? Cost of debt is 11.6. Sir, if debt ka weightage is 0.2 or 20% means equity ka weightage will be 80% or 0.8. And what is cost of equity under third option? 14%. Okay, how much is this? 13.52%. Okay, option number 4. If you have any issues, let me know. If I'm not hearing anything, I'll go forward. In the fourth option, debt ka weightage is 0.3 and debt ka cost of debt is 12%. If debt ka weightage is 0.3 or 30% means equity ka weightage will be 0.7. And what is the cost of equity in option number 4? 15. So summation will be 14.1%. Okay. Option number 5, overall cost of capital. Debt ka weightage is 0.4 and debt ka cost is 13%. If debt ka weightage is 0.4 or 40% means equity ka weightage will be 60% or 0.6. And option 5 ka cost of equity is 16% is what is given. So summation will be 14.8% is online ka answer. Same answer here also. Okay. Material answer. Okay. Now option number 6 ka. Debt ka weightage is 0.5 and the debt ka cost is 15. If equity ka debt ka weightage is 50% means equity ka weight also will be 50%. However, equity ka cost is 18%. So summation of this will be 16.5%. And last option ka overall cost of capital is debt ka weightage 60% or 0.6 and debt ka cost is 18%. If debt ka weight is 60% means equity ka will be 40% and equity ka cost is 20% under last option. So final number will be 18.8%. Okay. So these are all independent cases. Which one will you select? For they've asked optimum capital structure. Which one will you select? Optimum capital structure is that capital structure which will increase the value of the firm. The value of the firm has to increase means overall cost of capital has to be the highest or lowest. So which among this gives the lowest overall cost of capital? Option 2 has the lowest cost of capital among all of them. Yes or no? Therefore, what is that? Final remarks. Conclusion is what? Select option 2 as it has lowest KO and it will result in maximum value. Can I say maximum value of the firm? That's about the third question. We can't do 2 more. Have we reached that zone already? So if you want, we can take a 10 minutes break and we can resume, not wind up. I have 2-3 questions, so I have to do it. But if you want it, I can give you a 10 minutes break and resume. What? 10 minutes break. 10 minutes break.